Good morning, Mr. Loganathan, and also our participants today. By now, we have around 70 participants by now. I think all are joining. And Director, College for Banking and Finance, Ms. Godakanda, and also Coordinator, Mr. Meneka. I am privileged to welcome all our participants to this program, which is the Diploma in Credit Management. Before going to introducing our resource person, Mr. Loganathan, let me formally welcome all of you, all of our participants in this program. Actually, at the IBSL, we are trying to inculcate a principle that is we treat all our participants in all our programs as the future leaders of this country and the future leaders of the banking and financial industry. I would like to call this project as a tripartite project. There are three parties are involved. That is, we, the IBSL, are the facilitators, and also the resource persons are the guides. They are the people who are knowledgeable with the theoretical knowledge and practical experience. They are the guides, and you are the beneficiaries. You are the beneficiaries, and so this is because we have a responsibility. Our responsibility is to provide facilities for the benefit of the industry, to promote the human resources. So this program helps us to execute that responsibility. And also the resource persons also have the responsibility of parting with their knowledge and experience for the next generation. The next generation will take the baton that the resource persons have been having the battle for a long period as practitioners. Now they are going to hand over that baton to you. And we are the facilitators. You are the future leaders of this industry. So we are very much proud to participate in that national project. And also we are happy that compared to in the past, we had the opportunity of offering this program to many participants who were not able to participate in the past because of the distance and also the responsibilities that they have at home and in the office. This way, it is a very, now we have an expanded participation compared to in the past. We know that if we talk a little bit about this program, we know that the credit is, I'm not a banker anyway, I'm a central banker. The credit is the most important asset in the bank's balance sheet. And the other thing is giving the credit, offering the credit, and also getting it back, the repay, ensuring that it will be repaid back, affect our balance sheet and also NPL and our credit worthiness, our performance, everything is affected by how we are going to manage the credit. And the challenge is we are extending others' money to an unknown party, because others have trusted in us. Others are the people who have deposited their money with us with the trust that they will get it back with the due interest and all those things. And we can't afford to keep it because we have to earn interest income to pay it back and also for our survival and also the progress. So the credit is the most important function we have. Unfortunately, when we give credit, we don't have the complete set of information about the recipient of the credit and also his or her or the institution's motive of borrowing and also their commitment to repay it back. That's where we have to manage credit. Otherwise, we can ask, why should we manage credit? Because it should be managed because it is not going to be they behave in the same way that we want them to be. That's we have to manage. In that case, knowing the techniques of managing credit and also preparing credit proposals and also disbursement and also following it up to make sure that we will get it back. We know 100% of the loans are not recoverable sometimes, even though all our loans are good loans at the time of disbursing, they turn out to be bad ones sometimes. Because of the lack of information we had at the beginning to assess the loan, and also because of the lack of commitment, and also sometimes people borrow And sometimes unethical people also can borrow, and with the intention of not paying back, and they will try to avoid repayment whatever the way possible. So we are confronting that kind of clientele. It's a mixture of everything. Of course, more than 90% of the 95% of the customers are very genuine, but sometimes we encounter different type of people. That's why we have to have experience in credit management. So this has 8 modules, and we have 5 or 6 resource persons to deal with it. And there have been some are still operating, they're working in the banking industry as credit officers, also the supervisors at that level. And also some are retired and they are working as consultants. Before going to introducing our resource person, let me talk about little about the assessment also. Compared to in the past, the program that we are offering now have a little bit advanced techniques. Advanced in the sense now we have made it a little bit more comprehensive. You may ask why? Because earlier, compared to the early assessment, this assessment is a little bit stringent. You may ask why? Because now in the past, we had complaints from the industry leaders that even though we have offered credit management courses, sometimes the participants are not conversant in handling it when it comes to the practice. Therefore, we had to make sure all the participants who qualify are knowledgeable and also the competent in terms of practical aspects of managing credit successfully. So we have that responsibility. And also if we look at from your side, you are sacrificing your money and time for this one. It is an investment. If we don't manage our investment properly, it will be waste of time and effort and also the money. In simple, it is waste of resources. You have so many other responsibilities as most of you must be at a little bit of a higher level of your profession. Then you have responsibilities, and families also you have responsibilities, and also you have other social responsibilities. When you engage in following this course, you sacrifice all those things, in addition to the financial resources that you sacrifice. Therefore, from an investor's perspectives, also you have to do this with the commitment. And in that regard, I would like to share a little bit of my experience in handling these courses. We have 3 types of participants in general. Whatever the course you take, we have 3 types of participants. Some are really committed and they work until the last date to get the maximum benefit from that. Some just do it, and some drop out in the middle. These are the 3 type of participants I have observed. We know that when you engage in a project like this, you have a plan. The plan is to do it successfully and also to enhance your capabilities of becoming a credit officer in the future. Actually, a credit officer, a credit professional, because while in the bank or any other financial institutions, you can work like an officer. Now, if you take Mr. Loganathan, who is the resource person today, even after retirement, now they are contributing for the benefit of the nation as well as their own benefit. Because why? They have been very successful practitioners when they were offering it. And then they also have gathered knowledge. One day, you will be like Mr. Loganathan and the other resource persons. One day, IBSL also may seek your service as resource persons for the program that we are going to conduct in the future. By that time, I may not be there, Mr. Loganathan may not be there, our working team may not be there, but the IBSL will stay. And you are also the future resource persons if you do it really well. Therefore, I invite all of you, don't drop in the middle, and also don't wait until the last moment to prepare for the exam and also prepare for the assignment and all those things. And also, let me earnestly request, please don't copy from others, because by copying, you can submit the assignment or the project report, but at the end of the day, you will not gain the practical knowledge that is what matters. That is what matters when it comes to real delivery. Otherwise, you will be just a number holding set of certificates, but without having the capacity and the capability to perform as a credit officer. So, as I said, you are the future of the industry, and also you are the future of the nation. So, as senior officers, let me earnestly request, as an adult in this case, please commit yourself and get the maximum out of this. And our resource persons will give whatever they have for you to take back. And if you have any question, any problem in this, I am freely available, and you can email to me, call me, and also I also have the responsibility, both official responsibility and ethical responsibility, to address whatever the problems you have, to address them. With that invitation, let me introduce our panel. You may have already received Mr. Loganathan. Today he is going to be the lecturer, and Mr. Nawaz, and Mr. Christine Anaykara, and Mr. Rajanathan, and also Mr. Juman. Those are the 5 resource persons we have. And today the resource person is Mr. Loganathan. As I said, Mr. Loganathan is a consultant, and also he has been having a lot of experience. He has been with us for a long period in conducting these programs. And also he has started his career in the banking Mahagedara, that is Bank of Ceylon. We know, if you take the banking history of this country, Bank of Ceylon has been a place to train a lot of people and nurture a lot of people, groom a lot of people to take over the responsibilities in all different areas related to banking. So Mr. Loganathan is a product of that. In addition to that, he has gained an MBA, and also he also has followed so many other courses in his credit to enhance his knowledge in general banking, and also especially in the credit management field. And also he has worked in different areas like SMEs and credit management, and all areas of banking operations. And you may receive his CV, and there are a lot of achievements in his credit. And the simple fact that his services are sought not only by the IBSL, but also by so many other organizations in this field is a testimony about his knowledge and capacity and the leadership in this field. So with that, let me invite Mr. Loganathan to start the project. Sir, you are welcome, sir, to the program, and also let me hand this floor over to you, sir. Thank you.
Thank you very much, Mr. Karnapila, for your kind introduction. I'm really happy for your introduction. I'm very, very thankful to you. Thank you very much, sir.
Thank you.
Thank you. Good morning to everybody, all participants. Our Director General has invited you all for this interesting program. Okay, let us start now. Diploma in Credit Management. The first module we are going to do today, that is Principles of Credit Management, Lending Policies and Best Practices. This is the first module here. Today we are going to discuss Introduction to Credit, Types of Borrowers and Business Sectors. We are going to discuss today. Credit. What is the meaning of credit? In finance, credit is granting of a loan and creation of a debt. That means credit means loans and other advances, granting of loans and other advances. There are various advances banks are granting. So commonly we call it credit. So this is the meaning of credit in finance, banks and finance companies. Yes, here. In the commercial trade also, the credit is used. The term credit is used to refer to the approval for delayed payment for purchased goods. You know, you can see there are so many institutions. They are selling goods and they are selling it on credit. That is, you can purchase the goods, maybe a TV or a washing machine, you can purchase and you can pay that one in installments. That is also called as credit. That is in the commercial trade. So once again, in commercial trade, the credit is used to refer to the approval for delayed payment for purchased goods. So whether it is in the finance or in the commercial trade, the credit should be managed appropriately in these cases. So that we call it as credit management. Maybe in the finance field, that is the bank, finance company, or in the commercial trade where they are selling the goods, the term credit is being used and this credit should be managed appropriately. So that's what we call it credit management. Credit management. Managing provision of credit and its recovery. It should be carried out effectively and efficiently. The meaning of effectiveness and efficiency, you may know, but anyway, I'm just explaining you. Effectiveness means doing the correct thing or the right thing. That is effectiveness. When you do the correct thing or the right thing, we call it, it is effective. It is effectiveness. And then when you do the thing in the correct way or the right way, correctly or rightly, we call it efficiency. When you do the thing in a correct way or right way, you can achieve it. So we call it efficiency. So the credit management should be carried out effectively and efficiently. That means in the credit management, you must do the correct thing the correct way. You must do the right thing in the right way. That should be in the credit management. So when you do this, when you do your credit management effectively and efficiently, it should bring benefits to the lender as well as to the borrower. So lender also will be benefited, the bank also will be benefited, the borrower also will be benefited. We call it win-win situation. So in the credit management, we must achieve a win-win situation by doing our credit management effectively and efficiently. It should bring both parties benefit. Most of the time it's happening, but sometimes it doesn't happen. We must correct it. Sometimes it doesn't. Sometimes the banker may be affected, and sometimes the customer also, the borrower also may be affected. So we must see that both parties should be benefited by doing our credit management effectively and efficiently. Well, before going into the credit management proper, we just discuss about the history of bank lending in Sri Lanka. How the bank lending, the banking started in Sri Lanka. Though Sri Lanka is reputed to have used coinage in ancient times, there is no recorded history of banking prior to the 17th century. Actually, our old kings, queens, the leaders of ancient leaders, at that time the coins were used, coinage. So the Sri Lanka is reputed to have used coinage in ancient time. But there is no history of banking or bank lending prior to 17th century. It is true. When you analyze the history of Sri Lanka, before 17th century, there is no history of banking in Sri Lanka. Well, then Natukota Chettias, a migrant business community from South India, introduced a financial service system akin to banking during the Dutch period. And it continued during the British period also. Actually, during the Dutch period, you all know our country was ruled by the foreigners. First, of course, Portuguese came, then Dutch came, after that, Britishers came. During the Dutch period, there was a migrant business community from South India called Natukota Chettias. Still, the Natukota Chettias, that clan is there, that family, that clan is there in India. So they were migrant business community. They came to Sri Lanka and introduced a financial service system that is something similar to banking during the Dutch period. And it continued. Their intrusion helped only the affluent sector of the community who had connection with foreign entrepreneurs. Actually, so Chettias also came and introduced some system, something similar to banking. They also helped only the affluent sector of the community who had connection with the rulers. So they also didn't help all the general people, no. So they helped actually during the Dutch period and then during the British period. The both periods they were doing this one. They were helping the affluent sector of the people who had connection with the foreigners. First, of course, with the Dutch people and then with the British people. Right. So they helped in opening estates in plantation sector. So they were lending money for opening estates in the plantation sector. The coffee estate, tea, rubber. This is mainly during the British period. They were doing this, Natukota Chettias. With the expansion of trade with India and European countries under British rule, many banks were set up by British businessmen. So during the British period, Britishers mainly doing the business. Import and export, they were mainly doing. And then they were ruling the India also. So the India and Sri Lanka both ruled by them. So during that time, with the expansion of trade with India and European countries, they were exporting to European countries under British rule. Many banks were set up by British businessmen. So the British businessmen, they were setting up many banks in Sri Lanka. Many banks in Sri Lanka. Thereby the banking system, the real banking system started. In 1841, fully British-owned first commercial bank named Bank of Ceylon was established. So in 1841, a fully British-owned bank, one bank named Bank of Ceylon was established in Sri Lanka. What happened to that bank? This bank crashed in 1848. In say about 7 or 8 years' time, that bank crashed. The bank crashed in 1848 with a coffee crisis and had a devastating effect on the country's economy. What happened? The coffee estate, some pest attacked the coffee plants and most of the estates ruined. So this bank has lent to those coffee estates for establishing estate, for managing estate, etc. And with that one, they couldn't recover and that bank got crashed. And when a bank is getting crashed, that affects the country's economy. So at that time, the country's economy had a bad effect, devastating effect because of the failure of this bank. This happened in 1848. The name of the bank that time was One Bank of Ceylon. Then many foreign banks were operating during this period, especially the British period. Many foreign banks were operating and involved only in foreign trade in the island. That is import and export, foreign trade, these banks. They never provided any assistance to the local businessmen or any development activities. These foreign banks established by Britishers, they were lending and assisting only for import and export. They never provided any assistance to the local businessmen or any development activities. There were example in 1888, one bank called Hatton Bank that was established in the hilly area, in the estates area. Later, this bank amalgamated with other foreign bank, they converted into HNB, the present Hatton National Bank. Similarly, in 1920, Eastern Bank branch, the World Bank, there's a bank, Eastern Bank, they had a branch. So this branch later amalgamated with various other banks, branches, and later converted as the present commercial bank. If you want to know the history of HNB or the commercial bank, please go through their website. All these information are given in their HNB website as well as commercial bank website. Then all these banks, foreign banks, Britishers banks, helping for import and export and helping only the Britishers who had connection with the government at that time. So what happened? The local business community canvassed the British government for better banking facilities to expand their businesses, as they could not compete with British businessmen and planters because they couldn't get any banking facilities or assistance. So the local business community canvassed the British government. They couldn't compete with the foreigners, foreign business people, because they couldn't get any banking assistance. But the British government did not want to establish a Ceylonese bank. But the British government, they don't want to establish a Sri Lankan government-owned bank at that time. But the British government did not want to establish a Ceylonese bank. Well, anyway, however, Mr. George Edmund D. Silva, member of the State Council for Kandy, moved a motion in the State Council to establish a Ceylonese bank. Actually, that time, under the Britishers' rule, presently we are having parliament, MPs, member of parliament. Presently we are having parliament. That time it was State Council. And people were elected to the State Council from various districts and from various places. State Council members of State Council. One member, Mr. George Edmund D. Silva, member of State Council for Kandy. Actually, he was an eminent criminal lawyer at the time. He was practicing in Nuvarelia. He was elected as a member of State Council from Kandy. He moved a motion in the State Council to establish a Ceylonese bank, and it was supported by other members. And that time, Mr. S.W.R.D. Bandaranaike was a State Council member. Mr. G.T. Ponnambalam was a State Council member. There's so many, almost all State Council, Sri Lankan State Council members at the time, they all supported Mr. George Edmund D. Silva's proposal or the motion to establish a bank, Ceylonese bank. At that time, of course, our country, Sri Lanka, was called as Ceylon. So they mentioned it as Ceylonese bank. Subsequently, the British government couldn't do anything, but what they have done, they appointed a commission. They appointed a commission to look into this fact and recommend whether to establish a Ceylonese bank or not. They appointed a commission. One Mr. Sir Sorabji Pochanawala. That commission was called as Sir Sorabji Pochanawala Commission. Mr. Pochanawala was Indian banker, eminent banker. He was invited to chair this commission. And Mr. N.U. Jayawardena, at that time a great central banker in his young age, he was appointed as the secretary to this commission. And this commission discussed this matter with all other people and businessmen, others, even with the Britishers, and finally, Mr. Pochanawala's commission recommended for a Ceylonese bank to help the local people, business community. Sir Sorabji Pochanawala commission recommended. Then later, an ordinance number 53 of 1939 was passed to establish a local bank fully owned by the government. Then that in the State Council, presently the Parliament, we call it as Act. In the State Council, we call it as Ordinance. So later, an Ordinance number 53 of 1939 was passed to establish a local bank fully owned by the government. Thus, the present Bank of Ceylon was established on 1st August 1939 and commenced its banking operation to assist local businessmen and entrepreneurs. The present Bank of Ceylon was established on 1st August 1939, fully owned by the government. The first manager is a Britisher, Mr. Mortlock, and then Mr. Hunter. Following Mr. Mortlock, Mr. Hunter was the general manager. So these two gentlemen, they brought the British banking system to Sri Lanka through the Bank of Ceylon. And even the other banks established later, maybe People's Bank and other banks established later, they all followed this British banking system in Sri Lanka. And after Mr. Hunter, Mr. C. Loganathan was the first Sri Lankan general manager. Maybe my namesake, but anyway, I have not related to that Mr. C. Loganathan. So don't think like that way. Yes, Mr. C. Loganathan was the first Sri Lankan general manager of Bank of Ceylon. From there, the Bank of Ceylon started to help the local businessmen for the import, export, and even at that time, they were helping the development activities also by the Bank of Ceylon, by establishing a small poultry unit, establishing a cultivation unit. For those activities, for development activities also, Bank of Ceylon has started to grant facilities from that time itself. So this is the history of banking in Sri Lanka. I must tell you, I have narrated the story, but if you want to know detail of banking history, there is a book published by Bank of Ceylon on its 50th anniversary. On its 50th anniversary, Bank of Ceylon has published a book called Expanding Horizon. In all three languages, this book is there. That time I was a junior banker. I was involved in translating this book. Yes, if you are really interested in banking history in Sri Lanka, please read this book, Expanding Horizon. Well, now, let us move into the banking proper. Up to now, we have seen the banking history. Now, importance of credit to emerging economies. Not only to the emerging economies, all type of economy, even developed economies also depending on banking. Developed countries also depending on banking. So importance of credit to emerging economies. So there is a term called vicious cycle or poverty cycle. The people who have done economics, they may know about this vicious cycle or poverty cycle. What is that vicious cycle or poverty cycle? Now, when the poverty, when we say called poverty, less income. So when they have less income, now of course, anyway, less income. Poverty stricken people, less income. When they have less income, what will happen? They are unable to save. Less savings. Because they use that income for their consumption. Because of that one, even consumption also less. When the families have less income, their consumption also less, and their saving also, they were unable to save much. Less saving. So when they have less saving, what will happen? less investment. They are unable to invest on any income earning activities. They are unable to invest in any income earning activity. So again, what happened? Less investment, then less income. So the people get trapped into this vicious cycle. The poverty-stricken people get trapped into this vicious cycle. So once they get into this cycle, they are unable to come out. Less income, because of the less income, less saving, they are unable to save much. Since they are unable to save much, they are unable to invest much. So less investment. So less or no investment. Then because of less or no income, no investment, their income also less. So they are trapped into this one. How can they come out from this one? If you think, how can they come out of this poverty cycle? Some external assistance should be given by way of credit. By way of credit, some external assistance. So some external assistance by way of credit is given, then they can, yes, increase their investment. If they increase their investment, their income will increase. When their income is increased, they can save more. When they save more, they can increase their investment. So this will convert into, when the external assistance by way of credit is given, then more income, more savings, more investment, then more income. So this is the vicious cycle or poverty cycle. This is development cycle. Poverty cycle converted into development cycle. Really, if you want to develop, you must have savings. And they must consume sufficiently. So for that purpose, the external assistance, the credit should be given. Credit should be given. So this is poverty cycle people, they get trapped into this one. If they want to come out from this one, some external assistance should be given by way of credit, then they can increase their investment. By increasing their investment, they can get more income, more saving. When they get more income, they can save more, they can consume more sufficiently. And when they have more saving, more investment, development cycle. So this is for the poverty-stricken people. When in a country, when all the poverty-stricken people are assisted by this credit, then the country is benefited, country is developed, country is taking off towards the development. Country is taking off towards the development. So credit is important to alleviate the poverty. To alleviate the poverty. Right. Now, the credit, who provides the credit? In the rural areas, even to some extent, urban areas, suburban areas, the credit is provided by various people. One is, yes, okay, banks are providing. Banks, finance companies are providing. We call it formal credit institutions. Formal. Formal credit institutions. Formal credit institution. Apart from that, traders, money lenders, relatives, friends are also providing the credit. We call them informal credit institutions, especially the money lenders and traders. Informal. So there are two types of credit institution. One is formal credit institution, banks and finance companies. These are legal entities, legally allowed by the government, by the state to carry on the business of banking, lending, banks, finance company, formal credit institutions. And then traders, money lenders, relatives, friends, these are informal credit institutions. They also provide credit. You may wonder, money lenders, in the rural money lenders, generally their interest rates are very high. Their interest rates are very high. Okay. Then the traders, how do they provide credit? Traders in the rural areas, the people from rural areas definitely may know they are traders. So the farm families, they need money to purchase their consumption items, provisions. They need money to purchase seed, seed paddy or other vegetable seeds, and then fertilizers and weedicides and pesticides, chemicals. They need money. So what they do, they go to the traders, they borrow on credit these items. Even for their living provisions, consumption item, they borrow on credit. And for the cultivation purposes, the item they borrow in credit. So the traders, they provide out credit to those farm families. They do the cultivation, they get the harvest, and harvest, what do? They give it to those traders. So traders buy at their lower price. So yes, they buy those harvest and take and deduct their what they have advanced them together with the interest and give the balance to them. They take the balance and they do, the farm families, they take the balance money and spend that money, and again they come to the traders to start the new cultivation next season. So here also, eternally, they are indebted to these traders. In the rural areas, the farm families, cultivators, farmers, they are eternally indebted to the traders. So these informal credit institutions are no way helping the rural folks, rural people, rural cultivators, farmers. So really, the formal credit institutions should come forward to help these farmers in the rural areas by providing credit for them to, yes, alleviate their poverty by increasing their income. So the vicious cycle will be converted into development cycle. So in the rural areas also, you must know there are two types of lending. One is formal lending, other one is informal lending. In between there is one quasi-lenders, quasi, Q-U-A-S-I, quasi. That is neither formal nor informal. One example, rural, cooperative rural banks. Cooperative rural banks. Cooperative rural bank, quasi-lenders. They are neither legal, neither formal or informal. They are in between. Quasi. So three types of lending institution. One is formal credit institution, other one is informal credit institution, in between quasi-credit institution. Example, rural cooperative banks. Right. So, vicious cycle, poverty cycle, necessity of savings and credit for consumption and investment purposes, and then formal and informal lending, and takeoff of economic growth and development. For these purposes, the formal lending is a must, is necessary in a developing country. So ultimately, the vicious cycle converted into development cycle. Not only this one, then the employment creation. By this way, employment is created. That's also another important thing for a developing country, creation of employment. So the bank credit, the formal credit, helping to create the employment. And another important thing, SME development. Small and medium enterprises. Small and medium enterprises. Actually, not only in our country, even in America, SME is considered as an important sector for the development of the country. So any country, the SME development is very, very important. If you see, now you can see big corporates are there in Sri Lanka, not only in Sri Lanka, even America, yes. Apple computers, even so many. They all started in a small way as an SME, and they grow up to this level as a big corporate. So the SME development, the bank formal lending is very, very important. So when the SME develop, the country is developed, more employment creation, GDP growth, everything is there. For that one, bank lending, formal lending is important. So the importance of credit to emerging economies. So if there is a question, you must bring all these facts into your answer. Importance of credit, and you must understand this fact. Then only you can work like an efficient and efficient banker in the field of providing credit. Importance of credit to emerging economies. Right. Now we come to another important area. Sources and uses of bank funds. So bank is using funds in banking for the purpose of providing credit and other purposes. The banks are using money, cash, funds. So what are the sources of a bank for its banking business, and how the banks are using these funds? Sources and major sources: own capital. Own capital. Central bank actually decide what is the capital of a bank. Really, if a new bank is establishing in Sri Lanka, that bank should bring 20 billion as their own capital. 20 billion initial capital. Initial capital. Commercial bank. Commercial bank. Any commercial banks, when they establish in Sri Lanka, the initial capital should be 20 billion. Their own capital. Actually, in from 2020 January, this requirement is there. So central bank announced in 2017 that is from 2020, the first initial capital of a commercial bank should be 20 billion. If any foreign bank, if any foreign branch of a foreign bank, branch of a foreign bank, it should be 10 billion. For a foreign bank, it should be 10 billion. If it is a specialized bank, like development bank, it should be 7.5 billion initial capital. So own capital, it should be the initial capital. But when the business is going on, when the bank is granting more facilities, when the banks are granting more facilities, accordingly, their capital also should increase. The central bank describe it. Accordingly, you will learn later how this increase should be, you will learn later. But the initial capital for the commercial bank, it should be 20 billion, branch of a foreign bank, 10 billion, specialized bank, Sri Lankan specialized bank like a development bank, 7.5 billion. This is, they say, earlier, of course, actually, now I must tell you this one also, the banks are doing financial intermediation. Here the depositors, then borrowers. They mobilize deposits from the depositors and grant as facilities to the borrowers. Banks are doing as a financial intermediation. They mobilize deposits from the depositors, granting it to the borrowers as facilities, credit facilities. Earlier, this concept was not there. That is, bank should have their own capital. They may have a small amount earlier. They may have. So, depositors' money is granted. When the borrowers are not repaying, when the bank would collapse, the bankers will just go out without any problem. Who gets affected? The depositors affected. Depositors lost their money. Earlier, that's what happened. So because of that one, the importance of banks' own capital came into. The bank own capital should be sufficient to absorb any shocking. If there is any failures, they should be in a position to absorb that one. To such an amount of own capital, the bank should have with them. So because of that one, this own capital. Right, okay. This is their own capital. Then they will get deposits from the customers. Banks get deposit now, the deposits. So this is a one financial intermediation. Demand deposit, saving deposit, time deposit, foreign currency deposit. There are various types of deposit. So that is another source for the bank to do their banking business. Then borrowed fund. Banks are also borrowing. Banks are also borrowing. Apart from there, now they have their own capital. They mobilize deposits from the customers and borrowed funds. What is this borrowed fund? Credit line, one type of this credit line. The banks can get credit lines from the foreign banks or foreign institution, international institution. Bank can get funds from. Bank can get funds, credit lines. So they are the lender in a credit line, one side lender, other side the borrower. The lender can be international agencies like ADB, Asian Development Bank, or World Bank, IBRD, there are various international agencies, or international banks, even countries, yes, the lender. The borrowers can be in the country, banks, they can borrow. One example, Sri Lanka borrowed some time back from India, first of course $100 million, and then another $100 million to purchase of capital items. And we called it as Indian credit line. It was called as Indian credit line. So this type of facilities, when one institution granted to another institution, we call it credit line. So the lender can be an international agencies like ADB, World Bank, IBRD, IDA, and then international banks, maybe HSBC, like that, international banks, or countries. Even India has granted, China has granted various credit lines to Sri Lanka. Yeah. So there, what happened? They grant an amount, approve an amount. Approve amount with the interest rate, mention the interest rate, and the repayment period. In the credit line, all these things are mentioned. Amount, interest rate, and the repayment. If there are any grace period, yes, that also mentioned. And the borrower can withdraw the amount. Borrower can withdraw the amount. And interest is charged for the withdrawn amount. The interest is charged only for the withdrawn amount. Interest is charged for the amount withdrawn. So the borrower can withdraw in stages. So what is the amount withdrawn for that one, the interest is charged on. And then after the grace period, the borrower has to start to repay that facility. This is the credit line. So the banks also can borrow funds. This comes under borrowed funds. They can borrow funds under credit lines. They can borrow. So we call it credit line. So here, lender and the borrower, country, bank. So even the customers, for the customers also, banks can provide credit line. Customers. The customers can be business people, business companies. Yes, this is credit line. So the banks, one of the sources of fund, I have already told you, on capital, and then deposit, various types of deposit, and the borrowed funds. The borrowed funds, one type of borrowed fund, credit line. Through credit line, banks can borrow from other international agencies, other lenders. Credit line. Another one is the refinance funds. This is also a borrowed fund, refinance fund. Refinance funds. What is refinance fund? As the name says, it is finance, refinance. Example, in Sri Lanka, sometimes the commercial banks are really they don't want to lend for any, sometimes they don't want to lend for any development activities. Maybe like agriculture, industry, the development activities, they are reluctant. Commercial banks are reluctant to lend. The reason, the money they are lending to the development activities, their default rate may be high. That is one reason. Other reason, they can charge more interest, they can charge more interest. Instead of that one, if they lend that amount to the trading purposes, commercial purposes, then they can be sure about the repayment and the income also high, since they can charge more interest. Okay. But the government want to promote development activities through banking system. They want to provide credit facilities for development activities like agriculture and industries. Government. So the government says, okay, commercial banks, look here. You first lend for these development activities in a concessional terms and conditions. Under concessional terms and conditions. Especially interest rates, concessional terms and conditions, especially interest rates, repayment, collateral or security conditions. Relaxed collateral or security condition, relaxed. So the government says to the commercial banks, look here, these are the development activities. For them, you provide credit facilities under concessional terms and conditions. Concessional terms and conditions. Interest rates, low interest rate, repayment, yes. Comfortable repayment facilities and less collateral or security requirement. You first grant. And we will provide you that amount. But you grant for these development purposes, you first grant these facilities and in these terms and conditions. After that, you apply to us, we provide the funds, that amount as refinance fund to you through the central bank. The central bank provides. And for a definite repayment period and lesser interest rate, on that basis, we will provide you. You use that fund, the refinance fund, for all your purposes. You use it. So that is called as refinance funds. So first, the government says to the commercial bank, for these development activity, they name what are the development activities. Maybe agriculture or maybe industry, what type of SME facilities for SMEs, yeah, you provide. And under these terms and conditions, government will say this interest rate should be this much, the repayment should be like this, and the collateral requirement like this, the government says. You provide, and after that you apply for the fund from us. We will provide you as refinance funds. So these refinance fund, you can repay. And the government say, what are the terms and conditions to repay the refinance fund? So this is called as refinance funds. Now, one best example, the refinance fund for the agriculture, small farmer credit. We call it NCRCS, New Comprehensive Rural Credit Schemes. new comprehensive rural credit scheme. So this is provided earlier. The refinance funds were provided earlier. For this rural cultivation, paddy and other vegetable cultivation purposes provided. But later, the refinance fund provision, providing refinance fund was stopped, and instead of that, later interest subsidies. So earlier, the refinance fund was provided by the government for this under NCRCS, New Comprehensive Rural Credit Scheme, farm cultivation purposes. Production loan, to provide the production loan, we call it production loan, small farmer credit, that is production loan. For the cultivation purposes, paddy and other vegetables. So the government provided the refinance fund. First, the banks grant the facilities to the farmer, and then they will apply. The government, through the central bank, they provide the refinance fund. But later, anyway, that was stopped. Instead of that one, now the interest subsidy is granted. The reason, yes, there are certain reasons, yes. Anyway, but now for the industry development, still the refinance funds are provided. For the SME development, SME, there are various schemes. There are various schemes provided in operation to provide SME financing. So the SME financing, the central bank is providing the refinance funds to the commercial bank. So the banks can provide loan facilities to the SMEs, and then they can apply and get the refinance funds. So this is another source of refinance fund. And then another source of fund, debenture issues. Debenture issues. Debenture issues. What is debenture issues? Debenture issues. What is debenture issues? When we are borrowing from banks, we have to provide the collateral, security, and we must satisfy their conditions and everything, various conditions satisfy, terms and conditions, and we will borrow. An ordinary person borrow from the banks, provide the security and other satisfying various other terms and conditions, and they borrow. But in the case of debenture issues, big corporates or banks, big corporates, they borrow from the general public. They borrow from the general public. Borrow. And how do they borrow? They provide a debt instrument. Debt instrument called debenture. A debt instrument, and in the debt instrument they promise we will pay you after such and such period, maybe after 3 years, 4 years or 5 years, we will pay you at such an interest rate. So in the debenture instrument they will say the repayment, when they will pay, repayment, when they will pay, and what is the interest rate, at what interest rate they will pay you. So first the commercial banks or big corporate announce we are going to issue debentures, and for these debentures, what are our interest rate, we will pay you, and when are we going to pay you. And by issuing debentures, this is a debt instrument, we call it debt instrument. They give this debenture document to the public, general public, and borrow from them. So this is called as debenture issues. Almost all commercial banks issued debentures and they borrowed. And even the big corporates, some big corporates also, through the debenture issues, they borrowed from the. But before issuing the debentures, the institution which is going for issuing the debentures, they show that they are very good in their financial standing. They are very good in the institution, the banks or big corporates. Before going for the debenture issue, thereby they are going to borrow from the general public. They show the general public they are financially very sound. How do they show? By doing credit rating. By doing credit rating, through an international or local credit rating agency, doing the credit rating agencies, they show that they are very good. They are very good in their financial standing. They are sound in their financial standing. Then only the general public think, yeah, this institution is good and for borrowing. So they purchase these debentures and pay their money, debenture issues. This is another source. Refinance fund and then debenture issues, another source. And finally, euro or dollar borrowing. This is also like the credit line, borrowing from the foreign banks or foreign countries, foreign institutions in euro or dollar currencies, dollar borrowing. They're borrowing. This is also another type of credit line, borrowing, borrowed funds. So these are sources of funds. And finally, retained profit. When the banks are doing the banking business, they get the profit, they keep that profit as a retained profit, and that profit is plowed back. Again, they will use it for their activities. So these are the major sources and uses of bank funds. Once again, I am going through major sources. Own capital, I have mentioned about the own capital. And then deposits, mobilizing deposits, demand, saving, time deposit, foreign currency deposit, and the borrowed fund. So borrowing the funds from various other institutions. Banks can borrow. Under credit line, they can borrow. Refinance fund from the government, they borrow refinance funds. The debenture issues from the general public by issuing the debenture, the debt instrument, they give the banks, give the debt instruments, and thereby they are borrowing from the general public without providing any collateral. So that of course, their credit worthiness is shown to the general public. Fitch rating, they may do, first of course, they do the rating by through international or local agencies. They do the rating maybe through the Fitch or Standard and Poor. There is another rating agency. Fitch is one rating agency. Standard and Poor is another agency. Moody's is another agency. These are the international big three credit rating agencies. Big three credit rating agencies. Fitch, Standard and Poor, and then Moody's. Through them, they do their rating. So they show the general public we are sound in our financial standing by showing the rating, credit rating, by show their credit rating. We are sound. And then borrow from the general public by issuing the debentures, debenture issues. Almost all banks have done, and in Sri Lanka, and big companies, big corporates have done, borrowed from the general public through the debenture issues. So this is one way of source of fund. And then dollar or euro borrowing from the foreign institution. This is also another credit line. And finally, the own retained profits. That is, by doing the business, they have the profit, they provide back. Use that profit, retained profit. So these are the major sources and uses of bank funds. Then the major uses. the major uses. Major uses. How do they banks are using the funds? One is statutory reserve. Statutory reserve. Statutory means legal, mandatory, legal reserve. All the commercial banks have to keep a certain percentage of their rupee deposits. They are mobilizing the deposit, certain percentage of that rupee deposit, a certain percentage, they have to keep it with the central bank as a statutory reserve. They have to keep it with the central bank as a statutory reserve. And for this statutory reserve, central bank do not grant any interest. So it is interest free. The commercial bank, they have to keep the statutory reserve as a statutory reserve, certain percentage of the rupee deposits with the central bank, they have to keep. Statutory is a mandatory, they have to keep it. Now, the central bank announced what percentage should be kept with the central bank. Central bank announced. Presently, it is 2%. The present government, when they come, so they reduce the percentage as 2%. Is statutory reserve ratio, SRR. Statutory reserve ratio, the deposit, 2%. Earlier, sometime it was 12%, it was even 10%, 7%, 6%, like that it was earlier. So central bank announced. What is the rationale behind this one? When the deposit ratio SRR is high, says 12%, 12% of the rupee deposit will be with the central bank. So the lending amount will be less. The amount that can be lent by the banks will be less. And the interest rate will be high. But when they reduce the deposit, this SRR, what will happen? The bank can lend more. Only 2% has to be kept with the central bank. Earlier, it was 12% to be kept with the central bank. So when the 12% is the SRR, their lending amount is low. Since the lending amount is low, they can charge a higher interest rate, the bank. When the SRR is low, they can lend more. Only 2% have to be kept with the central bank. The balance money they can lend is more. So since they can lend more money, their interest rate is low than when the SRR is 12. So thereby the central bank manipulate in the sense the central bank, yes, to whether to lend more or lend less, whether to charge higher interest or charge less interest, the central bank can monitor it. So when the 2% is, when the SRR is brought to 2%, the banks are lending more. When the SRR is 12%, there is a credit squeeze, lend less. Credit squeeze, lend less, and the interest rate is high. Thereby, the statutory reserve. So when the lending, when the central bank want to lend more, when the central bank means when the country want to provide more credit to the public, they reduce the SRR. When the country want to, central bank want to reduce lending, reduce credit, they increase the SRR. So this is one use of the funds, use of the bank funds. Statutory reserve, it is mandatory. Then another reserve, liquid asset reserve. We call it liquid asset reserve. All banks have to keep certain percentage of their rupee deposits as cash and treasury bill. With the bank have to keep a certain percentage always of the rupee deposits with them as cash and treasury bill. We call it liquid asset reserve. It should be more than 25%. Liquid asset should be always more than 25%. But we observe sometimes it is higher. It is even went up to 30%. Banks keep cash and treasury bill as a liquid asset reserve. Sometimes it is more than 30%. Why this liquid asset reserve? Certain percentage of the rupee deposit should be kept with the bank themselves as the liquid asset reserve. Purpose is when the depositors come and ask for their money, the bank should be in a position to give it to them. So that means to maintain their liquidity. Liquidity means when the depositors come and ask for their money, the bank should be in a position to pay them. So for this purpose, this is also mandatory. This liquid asset reserve, all the banks should keep a certain percentage, more than 25% of their rupee deposit with them. We call it liquid asset reserve. Then credit facilities to customers. Now only the balance the banks can provide as credit facilities to customers. And securities investment. There is another use, important use. Most of the banks are using it. Securities investment. The banks are investing in securities. We call it investment banking. The banks are investing in purchasing shares of various other profitable institutions. Banks can, yes, purchase shares. The bank can invest in to have their subsidiaries, to create subsidiaries. Almost all banks have their subsidiary companies for leasing purposes, or for even various other merchant banking purposes. The banks are investing in subsidiary companies. There's a group of companies, then they all call that group of companies. Major parent company, under them there are various subsidiary companies. The banks. So banks have their subsidiary companies. For the subsidiary companies, they have to invest. So we call it investment banking, securities investment. In their own subsidiaries also they can invest, and within other profitable institutions also they can purchase shares, invest and purchase shares. So this is another use. And finally, fixed assets. Investing in fixed assets, purchasing the lands for their bank building, branches or head office, and then building, purchasing furniture and fitting, purchasing computers or hardware, software, purchasing vehicles, investing in fixed assets. So these are the major users. Once again, major users, statutory reserve, SRR, I have explained, and then liquid asset reserve to maintain the bank liquidity. To maintain the bank's liquidity, that is when the depositors come and ask for their money, the bank should be in a position to pay them. So many banks failed, even in Sri Lanka and in globally, because when they lost their liquidity. When the liquidity is down, the banks have collapsed. There are so many examples. So to maintain the liquidity, the bank should keep a liquid asset reserve with them. Then providing credit facilities to customers and securities investment, that is investment banking, investing in various shares of profitable institutions and investing in their own subsidiaries. and finally purchasing fixed assets. Right. Another important thing, overview of assets and liability management. Overview of assets and liability management in banks. What is the meaning of assets and liability management? Where can we see the terms assets and liability? Yeah, the people who have done their accounting, they know the balance sheet of any institution. Balance sheet. So there are two categories. One is asset and liability. So in the bank balance sheet also, there are assets as well as liability. So the overview of asset and liability management means active management of bank balance sheet. The meaning is active management of bank balance sheet. Practice of managing the risk that arises due to mismatches between assets and liabilities. Between assets and liabilities. Assets, bank assets, and then banks, liabilities. Bank assets and bank liabilities. This you can find in the bank balance sheet. You can find in the bank balances. So what are the assets of the bank? What are the assets of the bank? Actually, assets, land, building, furniture, fitting, computers, all the normal assets. Apart from that, bank credit facilities and other investments also the bank assets. Bank credit facilities and other investment, what we have seen now, these are the bank assets. Apart from the normal assets, land, building, apart from that one, what the bank is granting, the bank credit facilities, loans and overdrafts, all those things, bank credit facilities and other investments, what we have seen now, yeah, all are bank assets. And then the liabilities, bank borrowing, depositors from the depositors and other borrowing, deposits, and other borrowing, what we have seen now, are the liabilities. So these, the bank balance sheet will have these things. Bank liabilities, bank assets. Bank liabilities mean bank depositors' money, deposit plus the borrowing. If they borrow from others, maybe refinance fund or credit line of credit, various things, borrowing. Liabilities, banks liabilities. Bank assets, apart from other fixed asset, these are the credit facilities and investment. As long as these credit facilities and investment are paying back, repayment is good, these are good assets. But anyway, we call it risky asset. These are risky, sorry, won't be able to see, I think. These are risky assets. Yeah, because they are risk. If they don't repay, it won't be an asset. If there is a credit default, they won't be able to pay. Risky asset. So now, okay. So both these liabilities and the assets should match. They should match each other because we are using these credit facilities, the grant facilities, we are using these deposits and borrowings only. We are using both these credit facilities and assessment and investment. So between both, there should be match. Both should match. So that is the purpose of active management of bank balance sheet. So the bank, they must manage their liabilities and the assets. There should be matching. That should be matching. The liability and the asset should match with each other to avoid mismatches. So practice of managing the risk that arise due to mismatches between assets and liabilities. So there may be mismatches. There may be mismatches between these liabilities and assets. That may lead to risk. That may lead to risk. There may be mismatches. There may be. So to avoid mismatches between the liabilities and assets, it should be managed. It should be managed. So what are the mismatches? What are the mismatches? That mismatches will cause a risk. If there is mismatches between the liability and asset, that may lead to risk. So to avoid that one, we have to manage the balance sheet of the bank. So what are the mismatches? What are the mismatches? First one, interest rate risk. Interest rate mismatch. This may lead to interest rate risk. There may be a interest rate mismatch that may lead to interest rate risk. So obviously, deposit interest rate, other side lending interest rate. Obviously, the lending interest rate should be more than the depositor's interest rate. Obviously, then only the bank will have a margin. The bank will have a profit after paying all the expenses and everything, management expenses and everything. Bank will have a profit. So the lending interest rate should be more than the depositor's interest rate. Earlier, it was easy. Earlier, managing this interest rate was easy. Yes. But now, the problem is the banks are offering variable interest rates. Variable or floating interest rates. Variable or floating interest rates. So, the variable can be or floating, both are same meaning, variable. Some banks use the term variable interest rate, some banks using the floating interest rate. Earlier, at the same time, fixed interest rates also there. Fixed interest rates also there. Earlier, it was only fixed interest rate, earlier. But now, yes, variable or floating and the fixed interest rates also there. So the variable may be bi-monthly, or once in 2 months, or once in 3 months, once in 6 months, once in a year, or once in 2 years, for both sides. Liability side as well as the asset side. For the loans also variable interest rate, for the deposits also variable interest rate. So you must match. So you must see whether the effective rate on the credit facilities are more than the effective rate on the depositors. That you have to manage. If it is not there, if that is not managed properly, if the depositor's effective rate is more than the lending interest rate, then it is the risk. There is a mismatch that will lead to interest rate risk to the bank. Bank will have to lose. Bank will have to face a loss. So that is interest rate mismatch. That should be managed in the credit risk. Then the credit risk. That is the default of credit. Credit default. The bank is granting the facility. If the credit is defaulted, then what will happen? Sometimes the bank has to write off it. The loss, bank has to face the loss. So that should be managed. Whether the amount granted by way of credit facilities, whether those amounts are recovered, whether there is a credit default, what is the probability of the credit default, that should be managed. If more amount is lost, more amount is default, we call it NPAs, non-performing credit, non-performing assets, NPAs, non-performing assets. So if the NPAs or the default is high, then the bank has to face losses. So we call it credit risk. So that should be managed. First, of course, interest rate, that should be managed, both sides. Liability side as well as the credit side, asset side managed. Then the credit risk, that should be managed. Whether what is the probability of the credit default, that should be managed. And then the liquidity risk. That is the maturity risk. Other risk is other mismatch. Mismatch, liquidity risk. What is this liquidity risk? In the bank, liquidity risk. Now, one example, housing loan we are granting. We are granting housing loan. Generally, the repayment term is longer, depending on the age of the borrower. Some bank has granting facilities up to their 55 years of age. Some banks even to 60. Even some cases, it is even going to 70 years of age also. Housing loans are being granted. So maybe the repayment period, maybe if a 30 years person borrow a housing loan, if he can go up to 60 years of age, 30 years repayment period. On the other side, saving deposit we are using. At any time, customer can come and borrow. Customer can come and withdraw that amount. Demand deposit we are using. Anytime customer can withdraw that amount. Fixed deposit we are using. Maybe maximum 2 years. Or maybe with the automatic renewal. After that, customer can come and withdraw that amount. How can you use? So this side, deposits. Anytime withdraw, they can withdraw. Or in the case of fixed deposit, maybe 2 years. But here we are granting for say 30 years. Housing loan, 30 years person, when he borrow, if he can go up to 60 years of age, 30 years repayment period. Repayment period. So here the customer come and withdraw within 2 years or 3, maybe years. But we are going to grant for 30 years. How to match? How to match? If there is no matching, then that we call it liquidity raise, mismatch, maturity mismatch. Maturity mismatch. That will lead to liquidity raise. Bank will lose its liquidity. When the bank is losing its liquidity, they won't be able to pay their depositors. Bank may collapse. Oh. So how we are using? Yes. So there are various combinations of deposits. One is children's savings account. Children's savings or minors minors or children that can go up to the age of maybe 16 years. 16 years. And then banks' own capital, that is their own capital. Maybe retained profit. So it is a combination of these funds. Bank has to manage and whether they can grant these long-term facilities. So this also should be managed very carefully by the bank. This also should be managed very carefully by the bank. Otherwise, there will be mismatch, maturity mismatch. Maturity mismatch will come and that will lead to liquidity risk. This also should be managed. And then finally, foreign exchange risk. Yes, foreign exchange risk. Foreign exchange risk. Commercial banks are buying and selling foreign currencies. Commercial banks are buying and selling foreign currencies. Yes, they buy euros, dollars, pounds, and selling. So when they buy, they pay at a rate. When they sell, they charge at a rate. So this should be managed. Why? Sometimes if they buy the foreign currency at a higher rate and sell at a low rate, then it is a loss to the bank, the risk to the bank. In the foreign currency, if they buy at a higher rate and if they sell at a low rate, so that should be monitored. They must buy at a low rate and sell at the higher rate. Then only the bank will have the profit. So this foreign exchange risk also, sometimes the bank loses. Sometimes they purchase currency thinking that rate may go up, but unfortunately, sometimes the rate may go down. So bank has to face loss. So this should be managed very carefully. So these are the mismatches the bank should manage to avoid the risk. These are the mismatches the bank can manage, bank has to manage and to avoid the risk. What are the mismatches? Interest rate risk, credit risk, liquidity risk, that is maturity risk, and finally foreign exchange risk. So finally, this is the asset and liability management in the bank. So the bank has a separate committee to manage this asset and management. All banks, all finance companies, they have separate committees to manage this asset and liability management. We call it ALCO, Asset and Liability Management Committees. ALCO, Assets and Liability Management Committee, ALCO, we call it. All banks and finance companies they have. So in the ALCO committee, all high-ranking officers of the banks are there. Definitely DGM Finance will be there. And so many other DGMs and the CEO or the general manager will be there in the committee. They meet very periodically and decide all their lending interest rate, deposit interest rate, everything these committees decides and pass on to their branches for their implementation. So we call it Asset and Liability Management Committees. This comes under the Treasury Department of the bank. All banks and all finance companies have their own Treasury Department. Within that Treasury Department, this Asset and Liability Committee will be there. Very periodically, they meet and discuss various things related to these assets and liabilities of the bank. They decide what are the interest rate, what is the percentage of lending, everything. They decide and that will pass on to their branches. For the Asset and Liability Committee to decide, all the necessary information should be provided by the MIS department. by the MISM department, MIS, Management Information System. MS, a computerized, it is computerized management information system. They provide all the necessary information to ALCO, and the ALCO make decisions. All deposits and lending, all decisions, ALCO decides and pass it on to the branches for the implementation. So this is the active management of the bank balance sheet. So you must know all these things. Okay, let us have a small break. Now the time is 10:18. We have a break for 15 minutes. Well, come back. Yes. Let us continue. I hope all are there. Right. So the overview of asset and liability management I have explained. Sometimes the exam papers you will get short answers, short questions. The asset and liability management and bank sources and uses of funds you may get as short questions. So these, and apart from that, for you to practice in the bank, all these things, these are very, very basic things you should know. These are very, very basic things you should know. Right. And there's another important thing I must tell you. In this diploma in credit management, there are two question papers. Two papers. One is especially the accounting part. That is one paper, that is the main question. There are other questions also. But both papers you must get 51 marks for you to pass the exam and get the diploma in credit management certificate. You must pass both question papers. You must get 51 marks. In each papers you must get. So keep it in your mind. From now itself, as our Director General has advised you, now itself you follow this program. If you have any questions, you can ask. If you don't understand anything, you can ask us, the lecturers. At the end of this today's lecture, I will give you my telephone number. You can contact me. Similarly, other lecturers also you can contact and clear your doubts if you have any. So please follow this program very carefully and become as an eminent credit management professional, as the DG, Director General, has advised you, an eminent credit management professional. Okay. Now, another important thing, relationship banking. Relationship banking. I have already told you about financial intermediations, banks and finance companies and financial intermediation. I have already told you. Depositors, borrowers. Banks and finance companies mobilize the deposits from the depositors, the people who have excess money, and give it to the borrowers who need money for various purposes. Financial intermediation. So, Earlier, of course, the banks and finance company, they were doing transaction banking, which is transaction banking. What is transaction banking? They were doing the banking, then only the transaction banking, performing simple transactions with the customer. When a customer comes to the bank branch, he go and deposit the money to his savings or current account, or he give his check and withdraw the money, and he goes. So the officers and the bank people, they will do their other work and they wait. This is transaction banking. Customer comes, make a small, whatever the transaction he want, he goes. Or customer come, he wants a loan, he negotiate, talk, and he goes. This is transaction banking. So almost all banks and finance companies, they were doing this type of banking. Transaction banking, that is, the customer comes, do his transaction, either depositing money or withdraw the money or asking for a loan facility, and he goes. Only that. Then what happened? All are doing same thing. Finance companies, banks, all are doing same thing. Then there will be competition. There will be competition. So to proceed better in this competition, it's a competition among finance companies, banks, because they all were doing the same thing, transaction banking. One bank thought, we must do it in a different way. We must do our business in a different way to attract the customers. One German bank, they introduced a different banking, call it relationship banking. When all the banks are doing the transaction banking, where the customer comes and do his transaction and he goes off, one German bank, so that created a big competition among banks and finance companies. So one bank in Germany thought, so we must have bet in the competition. We must do very well in a competition like this. We must do very well. So that German bank introduced a relationship banking. What is relationship banking? Relationship banking means banks invest building in long-term relationship with its customers. The bank thought we must build a long-term relationship with our customers, thereby building the long-term relationship, thereby attract those customers and make the customers to deal with our bank continuously. Not only this customer, his family members, others, attract, create a relationship with the customer. We call it relationship banking. Oh. So in the relationship banking, what the banks are doing, offering customers a broad spectrum of financial products and services that go beyond simple accounts or transactions to strengthen their relationship with the customers. Once again, I read it. Offering customers a broad spectrum of financial products and services that go beyond simple accounts or transactions in order to strengthen their relationship with the customers. We call it, in the marketing, we call this cross-selling. When the customer comes for one purpose, okay, we do that purpose. In addition, we must tell him what are the other facilities available with us. When a customer comes to open an account for him, okay, right, we are opening his account. This is a simple transaction. In earlier, with the transaction, it's finished. Transaction banking. But now, it is not only that one, cross-selling. What is that? You will explain to him what are the facilities available with you, which can be provided to him, offering customers a broad spectrum of financial products and services that go beyond simple accounts or transactions. So what are we have? We have minor savings account, we have Vanida savings account for your family lady members, your wife, your daughters, and children savings account. There are senior citizens account. Maybe you have your father, elderly person, retired person, for them this type of thing. And these are the deposit side, even on the in the loan side. Yeah, what are the other facilities you have? You are cross-selling your products and services to them. Thereby, you create a strong relationship with the customer. So the customer will think, oh, this bank is good. This bank telling us these facilities, and how can they help us? So you are creating a long-term relationship with the bank. This we call it as relationship banking. Relationship banking. So now the banks are doing relationship banking. When the customer comes for only one purpose, yes, satisfying that purpose, then you are explaining to him what are the other products and services available with you. You are telling him. You are making aware your customer. And apart from that, demographic-based products. Demographic means population-based products you are creating. And you can sell that one to your customers. What are the facilities available for seniors, retired people, senior citizens facilities, and students, student loan facilities, students accounts. Yes, you are explaining. Cross-selling, creating a relationship with the customer. So thereby what happened? Create customer satisfaction and then loyalty to your bank. So when the customer is satisfied, when you are doing this relationship banking with the customer will get satisfied, customer satisfaction. When the customer satisfaction is there, he will be loyal to your bank, your institution. He will be loyal to your institution. Loyalty. You are creating customer satisfaction and loyalty. And apart from that, there are other benefits to you. There are economies of scale, economies of scope in collection of customer information. Now, when the customer comes, yeah, apart from your cross-selling your products, you are collecting information of the customer. What is his family? What are his family members? Where he lives? Where he has worked? Now, what is he doing? All those information which are essential for you to process any facilities in future, you are collecting. So thereby, the customer's information, customer's family's information are with you. So then there is economies of scale. When the customer comes, first time customer come, you are collecting all these information, you are granting the facility. Yes, after finishing this facility, when the customer next time he come, all the facilities are with you. You no need to collect all those facility again. Only thing, other additional facility, additional information you have to collect from the customer. Economies of scale, economies of scope in collection of customer information. Repeated transaction. So again and again customer comes, you have a lot of information about him with you. So when he comes next time, you no need to go for all these information again. You no need to waste your time and money by collecting the information which you already have with you. Only the additional information you have to collect. So thereby these economies of scale. Repeated transaction. Then reducing transaction cost to both the bank as well as customer. The transaction cost will be reduced. The customer again and again no need to come to the bank. You again and again you no need to contact your customer because customer's information are with you. So thereby the transaction cost will be reduced to both. So thereby enhance bank competitiveness. So bank's competitiveness will be enhanced, will be increased. So your bank, which is doing this relationship banking efficiently and effectively, will outcast other banks which are very low in the transaction banking. So almost all the banks are doing relationship banking now. almost all banks are doing relationship banking now. So in the relationship banking, the management appoint relationship managers. There are relationship managers. Managers. Relationship officers. So the bank management appoint relationship bank managers and relationship officers to deal with certain customers, especially in the corporate customers, big customers, all banks, corporate customers. There are relationship managers and relationship officers. All banks, for their corporate customers, big customers, very big customers, they have relationship managers and relationship officers. So each relationship manager will deal with 5 or 6 corporate customers. So these relationship managers will have all the information about those customers. They do relationship banking with those customers. But some banks I have seen, they have relationship managers for not only for corporate customers, even SME customers, SME customers, personal customers, business customers, other business customers. They have these relationship managers. Few bank has relationship customers for relationship managers for all type of customers. Corporate customers, SME customers, personal customers, and business customers, they have the relationship. But however, all banks have relationship customer managers or officers for corporate customers. All banks have. But few banks have these relationship managers and officers for other type of customers also. So thereby, they're doing the relationship banking effectively and efficiently. The banks which are doing the relationship banking, now almost all banks are having relationship banking. But the bank doing this relationship banking effectively and efficiently will do better way. And there we have competitiveness. When the competitiveness is there, they are more profitable. Their profitability will be high. So now it is the relationship banking. Almost all banks are doing. But the bank doing the relationship banking more effectively and efficiently will do better. Okay, right. Okay. So certain basic things we have learned. Now we are going for the type of borrowers and business sectors. The various type of borrowers will come to you for borrowing purposes. So we see who are these type of borrowers. Type of borrowers, individuals or joint borrowers. Individuals may come or borrowers, joint borrowers may come. Mr. Sumanasasa or Mr. Pereira or individual customers may come. Or joint borrowers, father and son or mother and daughter, father and daughter, 2 brothers, 2 sisters, jointly come for borrowing purposes. So these are individuals or joint borrowers will come to you, type of borrower. So these individuals or joint borrowers, mainly the consumption loans. We will learn consumption, what is consumption loan, we will learn today. For the purpose of getting the consumption loan, individuals and joint borrowers will come. Right. Then sole proprietorship customers. Another type of customers, sole proprietorship customers. So these are business customers. Sole proprietorship. sole proprietorship customers. So they are doing various type of businesses. That type of customers may come for facilities. So these sole proprietorship business customers, they should have their under Business Name Act number 58 of 1988. There is a act, Parliament Act, that govern this type of customers and their businesses. We call it Business Name Act number 58 of 1988. It's a Parliament Act. Under that act, there is provincial registrar of companies. Each province, there is a provincial registrar of companies offices there. Each province they have. With them, the sole proprietorship should have registered their business. So their business should have been registered. Business should have been registered. Registered business. Their business should have been registered. So registration forms they must have. With whom they should have registered? They must register with the Provincial Registrar of Companies. Provincial Registrar of Companies. As per Business Name Act number 58 of 1988. This is the act. Under that act, there is a Provincial Registrar of Companies. With the Provincial Registrar of Companies, the sole proprietorship should have been registered and the registration certificate should have been obtained. This is one. And apart from that, under local authority, the local authority may be municipal council, town council, urban council, or Pradeshiya Sabha. There they should have registered and obtained a business license. They must obtain a business license. Here the business certificate, registered business certificate, and the business license. So there are two documents necessary. One is the registration certificate and the other one is business license from the local authority, maybe municipal council or town council, urban council or Pradeshiya Sabha. They must have. They must have. So actually when they open the account, they generally open a current account. When they open the account, these documents should have been given to the bank with a mandate. With a mandate, account opening mandate, these documents should have been given. So sole proprietorships. They may have their business account, they may come to you for the facility. Yes, this is another type of customers. Borrowers. If there are two documents, registered business certificate with the provincial registrar of companies, another one business license from the local authority. Then another type of borrowers, partnerships. Another type of borrowers, partnership. 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 This also business customers. This also business customers. So this type of customers, they are governed under partnership ordinance. Under the English law, partnership ordinance is there. So partnership means two or more people doing the business collectively, together. Two or more people. Mr. Muthubanda and Sudubanda carrying on the business, or Mr. Silva and Pereira carrying the business, or Mr. A and Mr. B, or and Mr. C and D jointly carrying the business. Two or more people doing the business together. We call it partnership. Partnership. So this is governed by the partnership ordinance under the English law. And this partnership also should have registered. These two registration they must have. Registered business certificate with the provincial registrar of companies. They must register the business. Business registration they must have. And from the local authority, business license they must have. Their business registration. and the business license. And this business license, annually you have to renew. The business license, annually you have to renew. This registered business certificate or business registration, that is once and for all. Once you are registered, that is there. Once you are registered, it is there once and for all. This is registered business certificate or business registration. Yes. But this business license, annually you have to renew it. The partnership, they may come. So sole proprietorship may come, then partnership. Here sole proprietorship, one person doing the business. One person doing the business. Partnership, two or more people doing the business. Then the business, private limited liability companies. Yes, limited liability company. This governed under Companies Act number 7 of 2007. There's a Parliament Act number 2000, Act number 7 of 2007 that governed these private limited liability companies. So they have the business registration, their incorporation certificate. Other one, partnership, then companies, private limited liability company, private limited liability companies. So they have incorporation certificate. Incorporation certificate. That is registration with the Registrar of Companies. Registrar, TRAR, of companies. Registration with Registrar of Companies. For the Sri Lanka country, there is one Registrar of Companies, McCallum Road, Colombo. McCallum Road, that is their Registrar of Company. There are, of course, these private limited liability companies would have registered their company. We call it registration certificate or incorporation certificate. We call it incorporation certificate or registration certificate they must have. That is one thing they must have. And apart from that, they must have the business license, BUSINESS license from the local authority. They must have. So this is another type of customer, private limited liability companies, governed by Companies Act number 7 of 2007. So they must have registered their companies with the Registrar of Companies. For the whole country, there is one Registrar of Company. That office is there at McCallum Road, Colombo. So we call it incorporation certificate or registration certificate. Apart from that, they must have a business license, they must have. And another thing I must tell you, the private limited liability companies, all limited liability companies, they have a memorandum of article. So article of association. Sorry. Earlier, there was memorandum and article of association was there earlier. But now memorandum is not required. Article of association. This private limited liability companies should have article of association. Article of association. Article of association. That is this private limited liability company should have. So at the time of opening the account with the bank, that is in the current account, they must provide all these documents. Article of association, and that is the one article of association, and then business license they must give, and apart from that, resolution, board resolution. Their board companies, the private limited liability companies, board of directors should decide in which bank, which branch we want to open an account. So they must board resolution. They must give Apart from that, there are certain form number 1 should be given, form number 20. These are the things. Yes. Actually, this I am explaining to you the type of borrowers, but all these type of borrowers should have accounts with you. At the time of opening the account, they must give all these documents. So you must go through your bank document, circular instruction, circulars, and find out what type of customer, what type of document we must obtain at the time of opening the account. You must prepare and keep it with you for your information, for your knowledge. Right. Private limited liability companies. They also can come to you for borrowing purposes. Then public limited liability companies. I am raising this. The companies under Companies Act, I told you, Companies Act number 7 of 2007, Companies Act number 7 of 2007. There are companies establishing the companies in Sri Lanka. Private limited liability company. And then public limited liability companies. Yes, private limited liability, establishing private limited liability company and establishing public limited liability company. These are governed by the Companies Act number 7 of 2007. Companies Act number 7 of 2007. Now, in the case of first of one saying sole proprietorship, the business owned by one person. And then partnership, the business is owned by 2 or more people. Partnership. Private limited liability company, who are the owners of the private limited liability company? The shareholders are the owners. Shareholders. Here the maximum 50 shareholders. Maximum 50 shareholders in the case of private limited liability company. Any number more than 50, it is a public limited liability company. Any number more than 50 shareholders, so they are the owners of the company, shareholders. If the shareholders, if it is more than 50, then it is public limited liability company. So private limited liability company also will come to you. Public limited liability also can come to you. So in the case of public limited liability company, there are 2 types. One is quoted or listed. Other one is unquoted or unlisted. Both meaning same. Quoted or listed. Other one is unquoted. Now, quoted means these public company shares can be sold publicly and they are quoted in the Colombo Stock Exchange. Colombo Stock Exchange. Colombo Stock Exchange. They are registered with the Colombo Stock Exchange and their shares can be sold publicly from A to B or A to C, or that their shares can sell open. So that is quoted or listed company. Unquoted, not listed, unlisted, they are not yet registered with the Colombo Stock Exchange. So their shares, they can't sell publicly to public. Unquoted companies, they can't sell their shares public to public. Among themselves, they can, I told you, maximum 50 numbers of people, or more than 50. More than 50 is a public limited liability company. So in the case of unquoted, among themselves, they can sell. Among themselves, they can sell their shares. Right. So these people also can come to you for the facilities as borrowers. Private limited companies can come to you. Public limited liability companies can come to you. So type of borrowers. Then the statutory bodies. Statutory bodies. I'm raising this. Statutory bodies. The statutory bodies come from statute, S-T-A-T-U-T. Statute, statutory body. Statute mean, one meaning, Parliament Act. Statute mean Parliament Act. Parliament Act means that is passed in the Parliament. An institution is created through a Parliament Act is called as statutory body. This Institute of Bankers, Institute of Bankers by a Parliament Act, created by a Parliament Act. So Institute of Bankers is a statutory body. Sri Lanka Standard Institution that governed the standard of all these products and everything, standard institution, created by a Parliament Act, statutory body. Bank of Ceylon, created by a Parliament, now not the Parliament, State Council Ordinance, statutory body. People's Bank, created by a bank, Parliament Act, statutory body. So statutory body, there are various statutory bodies. So they also can come to you for bank facility. Then government institution can come, like education department can come, agriculture department can come, government institution department, they can come to you for facilities. Then the government also can come to you on behalf of the government, Mahabanda Karika, that is General Treasury, they borrow. On behalf of the government, General Treasury borrows. They also can come to you. They borrow internationally, even locally, they borrow. They can come to you. Then various societies, under Societies Act, various societies, cooperative societies, clubs, NGOs, they can come to you for borrowing purposes. So these are the various types of borrowers. Please keep it in your mind. All these borrowers, before borrowing, they must have the accounts with you. They must have either a savings account or a current account open with you. For the purpose of opening these accounts, they must provide certain documents to you together with the mandate. Mandate means application to open the account is called as mandate. Account mandate. In addition to the mandate form, they must give various other documents for the purpose of opening accounts with you. So you must know what is the type of customer, what are the type of document I must ask from them. In the case of private limited liability company, they must give the mandate, they must give you the article of association, they must give you the resolution of board of directors resolution, and then they must give the form number 1, there is a form number 1, and form number 20, the director's information. So these are the things. Similarly, all these type of customers, to open the account, what are the documents you must ask from them? You should know. So go through your manual of operation. All banks have manual of operation, various operation, how to carry out the operation. We call it manual. The instructions are there in the manual of operation. Apart from that, manual operation for operation of current account, manual of operation for operation of savings account, manual of operation for granting facilities, manual of operation for fixed deposit, manual operation for various operations. So by going through, so in the case of opening the accounts for various type of customers, what are the other documents I must ask? You must know. So going through the manual operation or the bank, your bank circulars, get this information and prepare a document, keep with you. That will help you. Clear? Now, overview of lending. So it is credit management course. So what is lending? Overview of lending. There are various type of lending we are doing. Various type of credit we are providing. Lending. One is consumer credit. For the consumption purposes, we are providing credit. We call it consumer credit. In the consumer credit type, one is personal loans. Personal loans. What is the meaning of personal loan? Purchasing a car or for personal use. Purchasing a TV, purchasing a washing machine, purchasing a computer. For these purposes, you are borrowing. We call it personal loans. Or for you to send your son abroad or daughter abroad for higher education, you are borrowing a personal. So personal. And other one is house mortgage loan. Housing loan. You are mortgaging your house and obtain a housing loan. So these are consumer credit. We call it consumer credit. Then commercial credit, business type, business loan, to do the business. So this also, there are two types. One is small and medium commercial loan. Doing the business in a small and medium way. Business loan, we call it small and medium commercial loan. And then corporate loans, big customers, corporate customers. Now, each bank will have a definition for their corporate customers. Depending on asset value of the corporate customer, and turnover for a period, maybe annual, turnover. What is annual turnover? Depending on the annual turnover. Then other one, number of employees. Number of employees. So each bank has a definition for their corporate customers. Their asset value should be this much. Their annual turnover should be more than this much. The number of employees should be like this. Based on that one, they categorize their corporate customers. So we call them corporate customers, each bank. So your bank, what is the definition of a corporate customer? What is the rationale? What is the requirement for a corporate customer? You must find out. Your bank. What should be their asset value? What should be their annual turnover? What should be their number of employees? Your corporate customers. And others are small and medium commercial customers. So you are providing small and medium commercial loan. Right. Then the development credit. Samvartana Nayam. Development credit, providing for the development purposes. So there are two types. One is microfinance, or small loans, microfinance, or microcredit. Other one is project loans. Project loans, especially for SMEs, small and medium enterprises. Small and medium enterprises. So development credit. And then international trade finance. This is another important type of commercial. This is also commercial credit, but we categorize as international trade finance for the import purposes or export. For import and export of goods, bank is providing credit facilities. For import of goods and then export of goods, bank is providing credit facilities. We call it international trade finance. So these are the 4 major categories of bank finances. Once again, consumer credit, bank providing for personal loans, house mortgage loan. Then commercial credit, bank is providing. Small and medium commercial loans, bank is providing. And corporate loan for the big customers. Then the development credit. So under that one, bank is providing micro credit or microfinance. And then project loans for SMEs, small and medium enterprises. And finally, international trade credit for imports of goods and exports of goods, bank is providing. But though we categorize as an international trade finance, this also commercial credit. People import and export for the commercial purposes. So international trade finance for import and for export. These are the 4 major categories. Now, lending for specific purposes. For what and what type of purposes bank are granting facilities? For what and what type of purposes? So now we have seen who are the type of borrowers. So what are the major areas of bank lending? Overview. What type of customers are coming to the bank for borrowing purposes? We have seen. Now for what and what purposes we are granting? Purpose of advances. For trading purposes, for housing purposes, agriculture, industry, tourism, small and medium enterprises, micro enterprises, and finally consumption. These are the major purposes for which banks are granting facilities, credit facilities. These are the major purposes for which banks are granting credit facilities. Trade. So under trade, there are various types. Wholesale and retail trading, we are granting. You know the meaning of wholesale? No? Selling the things in a wholesale. Dozens and 50 kgs, 100 kgs in a wholesale, big lot. And the retail, from the wholesaler he buys and sell to the retailers, to the consumers. Like 1 kilo sugar, 2 kilo flour, or 1 kilo salt, like that, retail trading. The wholesale selling, wholesale business, and then retail. If you are granting facilities for the wholesalers or the retailers, it is trade. Import and export. The people are importing the goods and people are exporting the good. When you are granting facilities, this also for trade purposes, trading purposes. Then the distribution. Yeah, there are distributors, dealership, agency. Now, Island milk powder produced by Island milk powder produced by Milko, and it is sold through the dealership. There are various dealers or agents throughout the island, throughout the Sri Lanka. There are various places. There are dealers, and through them it is sold. So dealership, agency. So if a dealership wants a facility or an agent wants a facility, if you provide it, that comes under the trade category. Services. There are various types of services provided. Technical services, professional trade services, hotel and restaurant services, communication, schools. These are services provided by various institutions. If those institutions providing services ask for a credit facility, and if you are granting, this comes under trade category. Then transport. Providing transport services. Public transport, that is transporting people from one area to one area. Colombo Kandy transport, or Colombo Gold, Colombo Yetna transport services, and the commercial services, commercial transport, that is transportation of goods by lorries. So if you are granting facilities for transport purposes, whether it is public transport or commercial, then it comes under the trade category. Similarly, the contracts, doing the contracts. Building contractors are there who are putting building on contract basis. One institution want to put up their head office, they give the contract to a contractor. So they are contractors doing the construction. Similarly, road contractors, building contractors, construction of road through road contractors, service contractors, providing the services. Now, hospital want cooked meal for the patient. So there is a contractor providing the cooked meal, providing the services. Or some other services, laundry services, like that. So contracts. If such contractors ask for a facility, and if you are granting, that comes under the category trade. Then the pledge facilities. Actually, the pledge facility won't come here. We delete that pledge facility. We will discuss later. Again, under another category, in the heading, we will discuss pledge facility. Right, we leave pledge facility now. We will learn that one later. Then the real estate. Oh, real estate, that is purchasing a big land of 5 acres, clearing, developing, blocking as 10 purchase, 20 purchase, like that, and selling. This is real estate work. Or construction of a very big building, a condominium building, 50 stories, residential apartment building, construction. This is real estate business. Purchasing a big land, clearing, developing, blocking and selling, or construction of a 40-story building, condominium apartment for the purpose of selling. If somebody for that purpose asks a facility, if you are granting, then that is real estate. That also comes under trade facility. So under trade, all these facilities, when you are granting facilities for all these purposes, will come under trade category. Then housing. Purchasing a residential property. Somebody want to purchase a house, residential property. Or somebody want to purchase a land and construction of a house in that land. Purchasing a land and construction of house. Or construction of house in own land. Somebody is having his own land. He wants a facility, credit facility, to construct a house in his own land. Or renovation and extension to a house. Somebody is having a house already, but he wants to renovate it or do in an extension. So all these type of purposes, when you are granting facility, that is called as housing loan facility. This thing called as housing loan facility. Agriculture. If you grant loan facilities for paddy cultivation or vegetable cultivation, fruit crop, mango, growing mango trees or banana, fruit crops, and the perennial crops. Perennial mean long term. Perennial mean very long term. That is perennial crops. Maybe the minor export crop, cinnamon, like that type of crops, perennial crops. So if you grant facilities for perennial crop, for the promotion, for the cultivation of perennial crop. So many years crop. Perennial means many years crop. Yes. Then the plantation crop. If somebody has facilities for tea, rubber, coconut, these 3 types called as plantation crop. So that is plantation crop facilities. Then livestock and poultry. If you are granting facility to purchase and rear dairy cows, or buffaloes, or goats, or pigs, swine, or poultry for the purpose of eggs, or for purpose of meat, broilers, and then fisheries and aquaculture. Oh, fisheries, there are fisheries farming in not the seawater, in a good water, there are fisheries. Fish can be grown, aquaculture, shrimp, prawn culture, or crab farming, you can do. So if you are granting facilities for all these purposes, for the paddy cultivation, vegetable cultivation, fruit crop cultivation, perennial crop cultivation, plantation crop cultivation, tea, rubber, coconut cultivation, livestock and poultry farming, or fisheries and aquaculture farming, then it comes under agriculture. Then industry. It can be a small industry, medium, or large-scale industry. So commonly industry, in loans for industry purpose. Manufacturing, if somebody want to manufacture soap manufacturing, or noodle food item manufacturing, bread, yes, manufacturing, then it is manufacturing. Industry. Processing, if somebody want to process certain thing and for the marketing, now gem processing, gem mining and processing, yes, then it is gem processing, yes, it comes under industry. Milling, paddy milling, or various other seeds milling purposes, seeds milling purposes, yes. Then mining, graphite mining or gem mining. From the earth, you are digging and getting them gems, or graphite mining. Yes. If you are providing facilities for these purposes, then it is called as industry. It is called as industry. Then acquisition of new technology, training of staff. Yes. Now, acquisition of new technology. Now, a company is having a industry. They want to improve their production, so they want to get a new technology. They want to get new technology, maybe from Japan, new technology. So they may get the machinery, getting the machinery with the new technology. And not only that one, they have to train the staff, train the workers on the new technology or new machinery, acquisition of new technology, training of staff. They need money to purchase the new technology with the machine with the new technology, and to train their own staff on the new machine, they need loan. Now, if you are granting that one, that also consider under industry. Then product or quality improvements. Product or quality improvements. Now, a company is producing certain product, they want to improve the quality. Quality improvement. So, they have to do improvement to the machineries and nothing. Apart from that, they want to obtain SLS standard certification. Sri Lanka Standard Institute, SLS. Especially, you would have seen the water bottles. Now, see the water bottles. In the water bottles, there are. I am looking for when I am using. I look SLS standard. Sri Lanka Standard Institution. They won't just give this. They won't allow you to put this SLS mark on your product. They will carry out an inspection. They will ask you to do various improvement. They will ask you to do various improvement. One is the lab facility. Lab facility to test water periodically. So one important thing, you must have a lab. If you are producing and marketing these water bottles, and if you want to have the SLS, SLS mark is a quality that tell us this is SLS mark is a quality product. It is a quality product. The SLS mark tell us it is a quality product. And to obtain the SLS mark, what the people have to do, the SLS, Sri Lanka standard institutions, visit the industry, go through everything, analyze everything, and gives conditions. And you have to satisfy those conditions. Then only you can put the SLS mark in your product. One important thing, the laboratory facility and the machineries to test the product. In the case water, periodically you must test the water, whether it is within the standard. So for that one, you need money. You have to establish the lab, you have to purchase the machinery for you to do the product or quality improvement. So if you borrow from a bank, that comes under industry. That comes under industry. And then marketing of products. Marketing of products. So you have products. You want to market. Marketing of products. So you want to market this product internationally. Internationally you want to market. So what you want to do? Dubai. Dubai you want to have an office. Most of the industrialists who produce products for the international marketing, they have their office in Dubai to do the promotion. So Dubai, you want to have a Dubai office to market your products, for the promotion, and for that you need money to establish an office in Dubai and to take your products and do the marketing, everything. Promotion, you need money. If you obtain that money from a bank, then it comes under the category industry. It comes under the category industry. So the industry, under the industry, for various purposes, we are granting facility. Manufacturing, processing, milling, mining, acquisition of new technology, training of staff, then product or quality improvement purposes, then marketing of products. Even not only in Dubai, even in locally also, if you want to do the marketing, you may need you need a vehicle to do the marketing of your product. Delivery vehicle. So that comes under the industry purposes. Comes under industry purposes. Small and medium and micro enterprises, very important area. So generally we call small and medium enterprises, and even smaller than that one, we call it micro enterprise. In the case of micro enterprises, small trade, petty trade. Sometimes the places you can see small shops, we call petty kade. We call it petty shops. That type of shops, self-employment, these are called micro enterprises. Somebody is doing a small, maybe candle making. He buy the raw material, make candles and selling. This is a micro enterprise. One person, or self-employment. The person and his wife and the children, they work in the candle making. Or similarly, small things. They're making and selling. Some people make string hoppers and selling. Take it in their motorcycle or in their van and selling string hoppers. Other food items they make. So these are micro enterprises. And little bigger than that one, small and medium enterprises. The small and medium enterprises are new and young ventures. They would have started within maybe 4 or 5 years, within 4 or 5 years. Those are new and young ventures. So they want facilities to start their ventures and market their product. When you grant that facility, it comes under small and medium and micro enterprises. These are very important area in any country. Small and medium and micro enterprises are the very important areas. So when you grant facilities, that comes under small and medium and micro enterprise. In the tourism, this is also another area. Construction of a hotel to promote tourism. If they ask for a facility, they are constructing a hotel for the tourism purposes. Yeah. Then already they have a hotel, maintenance and refurbishing purposes. Now it has been about 10 or 15 years. They want to maintain and they want to refurbish. If you grant, yes, then it comes under tourism. Tour and travel agents, yes. Now there are tour and travel agents. They have the agents. They want to establish an office and to promote tourism. If they don't facility, if you are granting, yeah, for the tours and travel agents, then it is tourism purposes. And similarly, tourist transport. They want to buy a big Volvo bus to carry tourists from one area to another area for tourism purposes. Maybe buying a big luxury Volvo bus. Then if you are granting facility, that consider under tourism. So the tourism purpose and consumption. Yes, consumption purposes. Purchasing vehicle for the personal use, purchasing a motorcycle or a car for the personal use, consumption purpose. Purchasing household goods, purchasing a TV or a washing machine, yes, consumption purpose. Educational purposes, sending your daughter or a son abroad for the higher education, you need money. If you are borrowing, yes, purposes, consumption purposes. You have a daughter, you want to give away her on marriage, so you want money to give dowry or marriage expenses, you are borrowing. If the bank is satisfied and granting the facility, that is also consumption purposes. So all these things, when you borrow for the vehicle for personal use, for the household goods to purchase, for the educational purposes of your children, or giving away your daughter on a marriage, all these things, when you borrow, that is considered under consumption purposes. Consumption purposes. So these are, yes, these are the lending for specific purposes. These are the various purposes you are lending. So all these purposes you are lending. You can lend for trade, for trading purposes, for housing, for agriculture, for industry, for tourism, small and medium enterprises, micro enterprises, consumption purposes. Okay. Right. And now today we are finishing little early. The purpose, the first day, of course, we should not trouble you much, and you must go through what you have learned today, all these things. Because of that one, we are finishing little early. And next lectures, we will go through the full till 12:30. And sometime we may go through after 12:30 also, maybe more than 4 hours also, maybe the following lectures. Today we are finishing early because you also should be happily go through what you have learned today. And if you have any doubt or any questions, you can contact me. My number I am giving you. You can contact me if you have any doubt or anything. Okay. Thank you very much. We are finishing now. Thank you. Thank you very much.